Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, also known as Mr. Valuation, bringing you another subscriber request 2-minute drill on a company that's going to be quite interesting from a valuation perspective, because I also call these lessons in valuation, and there's a lot of lesson about valuation in this upcoming video. So let's go ahead and get right into it. The company I'm going to cover today is Novo Nordisk. It's AA minus rated by Standard & Poor's, so it is investment grade. It has less than 37% debt, which attributes to its AA minus rating. And I want you to note it has a very consistent earnings growth rate. The orange line on this graph is an earnings growth rate over this time frame, averages 18.6%. And so we're using a PE equal to growth rate, Peter Lynch formula of 18.6. And that creates our value line for the long-term perspective here. So as you can see, the company's stock price has tracked along that line, plus or minus, and there are periods where it got overvalued, and that was clearly a very bad time to invest in the stock, where you'd have lost 21% of your money over a 2-year period, even though the company's earnings was actually quite strong. So the idea is you want to buy the stock when it's below the earnings line, sell it when it gets too far above the earnings line, as would have been a smart move here. Now remember, any time that the stock from this point forward was overvalued, even though the stock continued to go up in value for a short period of time, that eventually would have ended up in losses. Like for example, right here, you'd have lost annualized 35% of your money. You'd have actually lost 46% of your money, even though the stock did rise several percentage growth since that. What happened here was we had all the talk about the political things that are moving the market now, and we saw this company, even though they had really good operating results, we saw their price correct. But FastGraphs is an analytical tool to think with, and I want you to note when you change the time frames, the growth rates change. So this is the appropriate multiple for growth of 17.17%. That means we're drawing this line at a PE of 17. If I drop this to a 6-year graph, now the growth has been almost 24%, 23.89, and we're drawing the line at a PE at a 23 multiple. This is a tool to think with. You see earnings growth is actually, if you look at it on the long-term graph, you can see this acceleration in earnings growth happen starting in 2022. So as you draw the graph for these shorter time frames, you can see this 2022 period has been 23%, and the stock now looks undervalued with a PE of 16. But now the normal PE has been 35 over this time frame, except for here, just because it was normal, and it was even higher than that in the summer of 2024. Earnings determine market price in the long run, but emotions determine market price in the short run. Now, if you look at forecasting, the company's still expected to grow at 18%. So here we're going to draw the orange line at a PE of 18. All right, so that's what the fair value line would be. Since it's trading at a 16 PE, it would be slightly undervalued. So if we get 18% growth, almost a 3% dividend, the rate of return we can expect, assuming all these things happen as shown, would be over 25% going forward. So if there was a good time to buy Novo Nordisk, now could be one of those times. But keep in mind, the price could drop further before it started to rise or run away from you from here. The point is, it's up to you to do the research on the stock. Now, since it is a dividend-paying stock with a rather high yield, I also like to look at it from a standpoint of free cash flow. But I'm not really interested in valuing the stock on free cash flow. I'm interested in seeing is the orange line higher than the gold line in this case. So in other words, if they're going to pay a $2.41 dividend this year and they're going to generate $186 in free cash flow, that covers the dividend. Last year, they generated $2.22 of free cash flow to equity, and the dividend was only $1.33. And you can see they've amply covered their dividend with free cash flow all along. So it's a high-quality company that looks like it's beginning to get attractively valued using almost any metric you want to look at, including things like price to sales. All of those are available on FastGraphs. But my point is, use FastGraphs correctly. It's a research tool to think with, and it's dynamic, and it allows you to change time frames and see different views based on how the company was operating during that time frame. Anyway, thanks for watching. I hope you enjoyed the video. This is Chuck Carnevale saying, Please subscribe to the YouTube channel if you haven't already. Ring the bell, give us a like, and take a look at subscribing to Fastgraphs. It can really help you make smarter long-term investment decisions. Whether you're a day trader or whether you're a long-term holder, you can at least know the amount of risk you're taking with Fastgraph. I call it the value investor's best friend. Thanks for watching.